outlook for the euro for 2014 is based on two things: technical and fundamental analysis. I believe that a significant top in the euro appears to be in the making. It peaked in price in May of 2011 at 149.40. Now, the long-term trend is down, with the euro making a negative triple top formation in 2013. So the current price is around 136.50, and using technical analysis, the downside target measures to about 115, or about 15.5% lower than it is today. Now, fundamentally, a large move like this is most likely going to be due to the European economy remaining in a recession, and two, a stronger U.S. economy is actually prompting the Fed, as we know, to reduce the amount of dollars it prints to buy bonds. Now, quantitative easing has restrained the dollar and has kept it from appreciating over the last couple of years. And last, the Eurozone economy will trail the U.S. economy by about an average of 2% from 2014 and all the way through 2015. So it will also trail Japan's economy and Great Britain's economy by anywhere from 1 to 2%. So based on the fundamental and technical analysis, the euro, I feel, has room to drop, and I certainly am negative on the euro going forward. If the participation rate continues to shrink, I do not see any negative consequences for retailers like Walmart, Amazon, Costco, or Best Buy. I think that the Consumer Discretionary Exchange Traded Fund, that has a symbol of XLY, that holds the very stocks that I just mentioned. And for the last 12 months, XLY has returned over 35%, while the S&P has returned about 1/3 less than that particular ETF. So this is a very positive aspect for the market, because the consumer sector is really the most economically sensitive sector of the U.S. market. Now, this sector, I believe, is the most dependent on wage growth and GDP growth rather than what the actual participation rate is. So I see it not having any real effect on those particular retailers. Well, if we assume that inflation stays low, you have commodities like corn, wheat, coffee. I think that they will remain depressed and low. And really, I guess for lack of a better word, the word depressed is the most appropriate word for those prices. Now, there's an agricultural ETF, and that symbol is DBA. And that holds those very commodities that I just mentioned, and actually 12 other commodities also. Now, you look back at price for DBA in the commodity sector, it actually peaked in March of 2011, and it has dropped over 32% since March of 2011. So the charts are very ugly for commodities, and I just don't see any turnaround for those that I just mentioned unless inflation comes back, and I don't see that happening either. And as a side note on coffee, for the last 2.5 years, coffee beans have decreased in price by over 65%. However, the price of Starbucks, the stock, has increased from $35 to over $76. That's more than doubled. But the question actually should be, has the price of your non-fat mocha latte decreased by 65% like the price of coffee beans has? Well, I don't think so, but I still don't see these commodity prices resurrecting themselves unless inflation comes back in a much larger percentage than we're seeing right now.